When market conditions change, money moves. And that movement is what defines a risk-off environment. Understanding this doesn't just help you follow the market, it helps you understand why everything is moving at the same time. Most traders think a risk-off market simply means price is falling, but that's not accurate. Risk-off is not about price, it's about behavior. It's the moment when the market participants stop trying to grow capital and start trying to protect it. At its core, a risk-off environment is a shift in priorities, from seeking returns to avoiding risk, from aggressive positioning to defensive positioning. And that shift happens through one main force: capital flow. Financial markets are driven by capital allocation. When confidence is high, capital flows into equities, growth assets, high beta instruments, and speculative opportunities. But when uncertainty increases, whether due to macroeconomic data, geopolitical events, or shift in monetary policy, that behavior changes. The market doesn't change first in price, it changes in how money moves. In a risk-off environment, capital begins to rotate. It flows out of risk assets and into defensive assets. In practice, that looks like capital leaving indices like the US 100 and US 30, cryptocurrencies and high volatility currencies, and moving into the US dollar, gold, and government bonds. This is not random. It's a global reallocation of risk. For example, during an unexpected macro event, you might see indices dropping, you might see gold rising, and the dollar is strengthening at the same time. And that's not coincidence, that's capital repositioning. And here's something that many traders pretty often miss. Risk off doesn't start on the chart, it starts in positioning. The price movement you see is just the visible result of decisions that were already happening behind the scenes. The sequence typically looks like this. Perception of risk increases, and capital exit risk assets, demand for safe assets rise, US dollar and gold strengthens, liquidity conditions shift, and indices are repriced. Everything is connected. For traders, this is critical because a shift in risk sentiment can drive downward pressure in indices, strengthen defensive assets, increase volatility, changes in executive conditions. And these changes can happen so fast. Once you understand this, you stop seeing markets as isolated charts, and you start seeing them as part of a connected system, where movements in one asset are often driven by flows happening elsewhere. Professional traders don't just watch price, they watch where capital is moving, because that's what drives the market. A risk-off market is not just a phase, it's a shift in how global capital is allocated. And understanding that shift helps you understand not just what the market is doing, but why it's doing it. Markets are not random. They reflect where capital is flowing. Understanding that changes how you trade. Markets don't move randomly. They move as capital moves. A risk-off environment is not just about falling prices, it's about a shift in behavior. When uncertainty increases, participants stop seeking returns, and they start protecting capital. And that shift drives everything. Capital leaves risk assets like indices and crypto, money flows into defensive assets like the US dollar, gold, and bonds. Volatility increases, and market conditions become more defensive. This is why multiple markets can move at the same time, because they are connected through capital flow. Understanding this changes how you read the market. You stop looking at isolated charts, and you start seeing the system behind them. Investing carries significant risks and is not suitable for all investors.